Okay, so we are back with risk, and as I say, we start with apologies because here's Samantha now. That's it. Brilliant. So the next subject we are going to cover is the credit risk assessment module. And as I say, I've sent the apologies in for Angelina. So Angelina's great, and unfortunately, as I said, she had a family bereavement overnight, so unfortunately can't join us today. But look, you'll find Angelina great, and she's very helpful and efficient and on the job. So it's just a pity you didn't get an opportunity to meet her. But what we'll do is we'll give you, you know, a sense of what the whole subject is about. So just let me talk about risk, the subject itself. And I suppose the four modules it's very much two halves. So the first half of the course, I'll go through the individual modules with you. And really what I want to do with risk, because risk is mainly financially orientated. And I know some people just when it comes to numbers and comes to accounting and all that kind of stuff, they tend to go cold. And I know you're not an accountant, and I know you don't want to be an accountant. So that is, at the back of our minds. Risk by its nature is accountancy based. And what we really want to do more than anything else is to demystify the whole area of finance and accounts and all that sort of stuff for you. So the whole notes are presented in as clear English as we possibly can. So yes, of course, there's going to be terminology. You have to learn the terminology. I think it was Warren Buffett said that accounting is the language of business. So if you're going to be involved in a business, you have to speak the language. So yes, there will be terminology. My one bit of advice to you starting this subject is what we're looking to do is to explain it to you. And the people who have difficulty with this subject, and believe it or not, of the four subjects of the diploma, this is probably the only subject that people do have difficulty with. And the people who have the most difficulty are the people who, go down into such detail that they start confusing themselves. And so a lot of it is just about an overview. When I'm looking, and it's so important from a credit controller or credit management perspective, there will come a time in your career, if it hasn't happened already, where somebody will drop a set of accounts on your desk and say, are they good for 50 grand? And a lot of people, when they're looking at a set of accounts, they might as well be looking into a field. Like it's just a page with loads of numbers on it, and you're going, what's all that? And I suppose what we want to do mainly in this module is to just demystify it, that you know what everything is, where everything comes from, how it happens. And to me, what I'm interested in, I'm more interested in the story than I am in the individual numbers. Is that okay? So yes, it is accounting based. It is not accountancy, and you are not accountants. What we need you to be able to do at the end of this module is to be able to read and critically analyze a set of accounts and use it as one of the tools in credit risk assessment in order to make a decision. Because to me, credit management, some people see credit as just its collections or its debt collection or it's whatever. To me, credit management is far more than that. Credit management is about, when I'm talking to senior managers and stuff, I would advise them that credit is about the management of the margin. That's what we do. Salespeople sell, and accountants, wonder, can you get a cheaper one somewhere else? Whereas in credit, what we have to be focused on is profitable sales. And as I rose through the ranks of organizations and became on the senior management team, that role of sort of profit maximization and being the person who just made sure that we were profitable, that the business is profitable. And to be honest with you, even though a set of accounts will tell you that a profit is generated when a sale is made, I hope that in this room we realize that the profit is really only materialized at the point of payment. So you can grow a debtor's ledger as big as you like and think you have great sales and think you have great profits. If you're not getting paid for it, that profit is not going to be realized. So we have a big responsibility here. And part of our responsibility in credit management is to decide who we're going to do business with. That's a huge decision that we have to make. And part of my mission here is, to ask the question, does it make sense? Are we going to make money out of this? Because if you said you would have 10,000 order to a company that's going to close down next week, that order is no good to the business. And unfortunately, as we're going through, and we're going through pretty turbulent times now at the moment, so risk is kind of at an all-time high. You can see the number of insolvencies is increasing, particularly in the hospitality sector, the business services sectors. There's a number of sectors out there that are particularly prone. And if you know what you're looking at and how to view it, you can then make the best possible decision. And credit, again, is not a negative function. It's a positive function. We are here to make sales. And we give credit because it helps us to sell more. That's why we're giving credit. So we have to make sure that we're making the right decisions for the right reasons with the right customers. So that is what the whole thing is about. So I'll just share this screen with you. Just let me do this here. Come on, slideshow, and then minimize that one. Now I can share my screen. Screen 2. Share. Okay, and again, these slides will be included in the pack I send you as well today. So Angelina, that's her contact details, that's me. And look, by all means, talk to Angelina. Feel free to come and talk to me as well. So if anything doesn't make sense, or you're looking for more information, I am quite happy to do that. So just let me go through the 4 modules so you know what to expect. So the first 2 modules, as I say, are accountancy based. And, again, let a lot of the details wash over you. What I want to do is, and what we do in the first couple of modules is, we start at the very basics of kind of setting up a business to show you all the accounting transactions. And look, to me, it's very, very simple. In a business, money comes from somewhere and it goes somewhere. That's it. So the money has to come from somewhere and it has to go somewhere. And what accounting is recording those transactions. So we can make this as complicated or as simple as we like. So what I want to do is, and the purpose of the first module, just to give you a bit of background in terms of accounting concepts and regulations. We do go into the terminology because as I say, it's important to be able to speak the language. And again, this is just for your knowledge. You don't have to remember, because remember the exam, you will have the notes beside you when you're doing the exam. So this is not a memory test. What I do need you to know is, though, and particularly with the new rules, so the accounting body have decided to standardize terminology around the world. So you might hear some new words that you don't know, and accountants are great at having 3 different names for the same thing just to confuse us mortals. So we go through the reasons for bookkeeping, the accounting concepts, the rules, the terminology. So for example, where you probably have heard of a profit and loss account, in the new accounting regime, that is now known as an income statement. What was formerly called a balance sheet is now called a statement of financial position. So they have changed some of the terminology here. Look, there's nothing that complicated in it. So just that you're aware of that. So we will go through the terminology that and understand what everything is. we start with setting up a business and we look at all the individual transactions within the business. So now, because it's an exercise, we look at this, each transaction happens individually. So you can see where, you know, you buy a truck. So you're increasing the value of your trucks and you're decreasing the value of your bank if you pay for it with cash. So every transaction has this is our double entry bookkeeping. So the reason for double entry is that we record where the money came from and we record where the money went to. So if we buy a truck for a tenner, we take the tenner out of the bank, so that's where the money came from, and then we give it to the truck manufacturer to buy a very cheap truck. So that's that. And just so each individual area of business has its own accounts. So we'll show you the double-sided entry and accounts and give you some experts on, you know, advice on that. Then we move through to the trial balance. So when we have all our individual accounts for all our individual incomes and expenditures, then we extract them into what's called a trial balance, where we list all our account balances. And again, that should always balance. Your trial balance should balance because the amount of money coming in and the amount of money going out has to be the same. And if it isn't, the difference is your profit. So we look at the trial balance and extract from the trial balance the profit and loss account. So, and this is sometimes called a trading profit and loss account. And trading is simply buying and selling. So anything to do with buying stuff, selling stuff, you know, the costs associated with it, that is in your profit and loss account. So that is your income statements. Now, yes, we have to make adjustments to it, and sometimes people get confused with adjustments. But look, adjustments are very simple because, and it's not a random thing, because your profit and loss account shows if the business made a profit or a loss for a defined period in time. So it's usually from, say, the 1st of January to the 31st of December. So your profit and loss account looks at that period in time and says, did you make a profit or did you make a loss in that period? So in order to keep the numbers consistent, there are adjustments that we have to make. For example, if we paid 12,000 for insurance on the 30th of November for 12 months insurance. Now, the 12 grand has gone out of the business. We've written the check to the insurance company. We have to record the 12 grand is gone. The fact of the matter is, though, only 1,000 of that relates to this year and 11,000 relates to next year because we paid our insurance on the 30th of November for the 12 months. So on that basis, yes, we wrote a check for 12 grand. We have a check for 12 grand. 1,000 of that is this year's expenses and 11,000 is next year's expenses. So when we're making adjustments, it's just to make sure of the integrity of the figures that we're looking at, that it absolutely matches and everything is correct. So that is the profit and loss account. And when we extract that information and put it in a set format, and it's a formulaic format, you know, learn that format. And whether you're looking at a sole trader set of accounts or a PLC, the format is the same in terms of what you sold, what you bought, what profit you made, what expenses you encountered along the way. And when you do your sums, you work out what profit you made. So that is all that's involved. So in module 1, we look at the whole profit and loss account and the structure of it and where everything comes from. So that is important. And then we look at the stuff. And then the other thing that I want you to understand as well is markup and margin and gross profit and all those kinds of things, because, you know, we have to look at a business. If our customer's business is profitable, then chances are they'll stay in business. If the business is loss making, then we have to look at it a bit closer. If they've made profits every year for the last 10 years, chances are they'll make a profit again next year, all other things being equal. You know, so it's about looking at the trends as well as looking at the numbers. So knowing what it is and where it came from, That is incredibly important. And then we move on to module 2, and we start with, again, the income statements as well, explain the whole concept of adjustments to you and why you would make adjustments and where they come from. Then we look at our profit and net profits, and and there's lots of, and you see this in the terminology. You've heard of EBIT or EBITDA or profit or margin, or so there's a lot of similarities there, and just to understand them as well. And then we move on to the balance sheet. And the balance sheet are the statement of financial position. That is simply a list of everything that the company owns and everything the company owes at a specific moment in time, which is close of business on the last day of the financial year. So your balance sheet is just like taking a picture, going click. That's our position at that moment in time. So our trading profit and loss account deals with our trading, our buying and our selling, and did we make a profit? The balance sheet is a list of what we own and what we owe at a moment in time. And again, the balance sheet, our statement of financial position, has a set format. It's a formula. It starts with your non-current assets, your fixed assets, your current assets, your current liabilities, your long-term liabilities. So it's set out in a format, and that's what it's all about. And what we'll do is then we look at our current assets. They're the assets that move through the business, your stock, your debtors, your bank. We look at your working capital, all the kind of various derivatives from the information that you get, and look at then where the money came from, be it capital invested or where it is. So by the end of module 2, you should be very, very familiar with a full set of accounts, trading profit and loss and balance sheet, or income statement and statement of financial position, whatever you think. And that's what it's all about. And I can tell you now that your first assignment will be based on those 2 modules. So what we will do is, for your assignment, you will be given a trial balance, which is just a list of balances from a set of accounts. And then you have to work out, did they make a profit? Did they make a loss? What do they own? What do they owe? So you have to go and prepare a set of accounts. And it's just to make sure that you understand what everything is, where everything goes, and more importantly, why it goes there. So that is the situation. So that will be your first assignment. You'll be asked to produce a set of accounts for a company. And as I say, we will have a revision session on that, just to make sure that you're on the right track. Because that, to me, module 1 and module 2 is the foundation of accounting knowledge that now I understand, and I know where everything comes from. And now I'm in a position to read it. And then we move into module 3. So module 3 now sort of takes the profit, loss and balance sheet, and we work to the next level of that, which is interpretation and analysis. So what we do is we take the numbers and we give you formulas, and we give you ratios, and we give you all sorts of stuff that you will be able to interrogate the figures yourself. So many credit controllers rely on the credit safes, or the D&B or whatever, or VisionNet, all these kind of companies. Now look, the companies are great. I wouldn't knock them for a minute. They have fantastic access to information. Every business is different. And just because VisionNet or Credit Safe say they're good for 50 grand, that doesn't mean that you can't do 100 grand's worth of business with them. And if you know how to read the set of accounts and do your own sums and stuff with it, it just gives you the confidence to be able to make better decisions and do more business and make more money for your company. So this, to me, when we get into module 3, this is where it gets interesting. And you see, what we can do is we look at different questions. Now, the one thing that I will advise you here straight away, and that is that we are credit people, all right? We are not accountants. So if you go to your accountant, some of the things that we will tell you will probably be the opposite to what your accountants will tell you. Is that okay? Now, and I'll explain to you the reason for that. Because we are looking at a set of accounts from a credit perspective. So the accountant is looking at a set of accounts from the company's perspective. Example is an accountant will tell you that the higher the creditor's figure is, the better it is. So the longer you get to hang on to your supplier's money in your business, the better it is for the company, because cash flow being king, if you can hang on to supplier's money, that's a good thing for the business. And I understand where accountants are coming from there. The reality is we are credit controllers. We like people who pay their bills on time. And when we're looking at a set of accounts, this is a potential customer. And we like people who pay their bills on time. So to us, a high creditors figure, while yes, it may be good for the company, it may not be good from a credit perspective. So I'm always looking at accounts from a credit perspective as well. And to be honest with you, in terms of what your key ratios and your key analysis are, again, accountants will tell you, oh, the most important thing are profits or net worth, how much the business is worth and all that kind of stuff. And again, I do not agree with that, because we are credit guys. So to me, the most important thing, and when I'm looking at a set of accounts, what I am looking for is, does the company have the ability to pay their bills as they fall due? That's what I'm interested in. I'm interested in their liquidity, in their solvency, in their ability to pay their bills. Because, you know, a company could have, you know, $1 million, you know, $1 million quid's worth of net worth. And then when you look at it, you know, $750,000 is a company Ferrari that's owned by the managing director or something, you know. Now you can't bring Ferraris to Tesco, and while yes, the company might be worth an awful lot of money, if they haven't got the money in the bank to pay their bills as they fall due, then we have a problem. Can you see where I'm coming from with this? So, you know, we need to go through analysis. We need to look at KPIs, and then what we'll do is we'll look at one figure here and one figure there. So, for example, just to tell you, say for example, the company's sales were 12 million for the year, and say for example, or say their purchases were 12 million for the year, and then I look in the balance sheet and I see the creditors, the amount they owe their creditors is 6 million. Now, it doesn't take a degree in finance to work out. Hold on, they bought 12 million quid in the whole year. They still owe their creditors 6 million. Like, it's taken these guys 6 months to pay their bills. Like, these aren't people that I'm particularly happy doing business with. Now, if other people want to give them crazy terms, that's their business. So what I'm concerned with is, do these guys have the wherewithal? Do they have the money in the bank, the cash flow that will enable them to pay us when they're due to pay us? So that is what the analysis and interpretation of financial statements is. So that's a key part of, and we give you 12 ratios. And I know if you go into accounting books, you might say, Declan, there are 2,000 ratios. Yes, and there might be 4,000. The fact of the matter is, the 12 ratios that I will give you are all the 12 ratios that I ever needed to analyze accounts in the real world in all my years as a credit manager. And I'm only looking for 3 things. I am looking for liquidity, which is their ability to pay their bills. Profitability, are they making money year on year? And management efficiency, how well run is the business? So, you know, if they're overstaffed, if they're overstocked, if they're, you know, there's loads of money, and the accounts will tell us this if we know where to look and what to do. And that's what this course is going to tell you. So endure module 1 and 2 to understand the basics, and then we get into what I think is the meatier stuff here as well. And the ratios, there's only 12 ratios. You don't have to learn them off by heart. What we do expect, though, is that you understand what the ratios are and what they're telling us, so that is that. And then we move on to module 4. And again, we take so we move then to credit scoring. So what we'll be able to do in module 4 is, if we are given a set of accounts, or we get a set of accounts from somebody, we will be able to develop our own scoring models. Okay, and these are, again, tried and tested over the years, and will give you a great indication, and we'll be able to do, credit scoring for companies. We'll be able to analyze companies to say which is good, which is bad, which is medium. There's a Z score as well, where the Z score is a combination of ratios that will kind of give you an indication how long a company has to live, which is no harm to know as well. And comparative analysis is where I have 3 companies in the same country or the same industry or the same group or whatever. And by putting the figures side by side, I can now work out which of those 3 companies is the best and which is the worst and which is the middle. So if you want to establish risk categories within your business between high risk, low risk, and medium risk, which I would highly recommend, and we cover it in credit management as well, because you can't look at everything. So what I have to do is I have to focus my attention on the most important things. And if I can identify my high risk customers, and particularly my high value, high risk customers, that's where I put most of my focus on, because the low risk customers, the chances of loss there is minimal. As long as I have my admin systems right, that'll work. And that's what it's all about. So we look at different companies in the same place. Then what we'll also do is, classification of risk. So this is high, medium, low risk. And look, simple traffic lights, and it's a way to do that. And then if you can organize your ledger in terms of the risk, and rather than waiting for a letter from a liquidator or receiver, you can see the trends over time. And to me, in my whole working career, I had a few shocks, where a company just went bang out of the blue, and I went, oh my God, I didn't see that coming. I think in all the years that happened twice, and I could name them. Usually there's a history, there's a bounce direct debit, there's delays in payment, there's increases in queries, there's all sorts of little warning signs along the way, that any one of them is understandable. When you get 2 or 3 together, it could spell problems as well. So that's our risk management. Yes, unfortunately, we do have to look at bad debts. And look, bad debts are a fact of life. No course you ever do or business you ever go in will be 100% and no bad debts. Yes, you'll have bad debts. And if you said to me, Dec, I've been a credit manager for the last 20 years and I've never had a bad debt, then I would say to you, well, maybe your credit policy is so damn conservative and so tight that you're missing huge opportunities for markets that you could, very profitable and lucrative markets that you could be going into and making far more money than you already are. So look, doing business involves a certain amount of risk. Now we have to manage that risk, mitigate that risk, to minimize it. Bad debts are a fact of life. And, if you said to me, Dec, your job is to have 0 bad debts, then I'd only deal with blue chip companies and government departments, and I'd be restricting the business. So that's what it's all about. So we have a look at bad debts, we have a look at doubtful debts, we have a look at provisions, which I'm a huge fan of from a credit management perspective. So we look at our bad debt provisions. And to me, as a credit manager, I would manage the provisions almost as tightly as I'd manage the ledger. And a lot of people, the accountants do the provisions. No. For me as a credit manager, the provisions, I always describe the provisions, the bad debt provision, as the padding on my posterior. And what I meant there was that if we did have a bad debt, the first question that's asked in the boardroom is it provided for? And the answer to that question is either yes or no. And if we have a provision in against that bad debt, what that means is the bad debt is not going to hit that week's, quarters, months, or years' profits because it's already provided for. And that's okay. Nobody dies if it's provided for. If it's not provided for, then that loss will hit straight to the bottom line and will impact profitability. So, as a long-term successful credit manager, you must make sure we have adequate provisions that if anything goes wrong, it's covered and no harm is done. Nobody will die. So that is that. And then, of course, it is risk. So we look at the whole business failure, lists of warning signs to look out for, payment behavior, being able to contact them, and making a loss, that's not the end of the world, certainly, 2020, I think, was a good example of companies making losses all over the place. That was just the business environment at the time. So a loss is one thing, as long as you have the ability to bounce back. So it's not about overreacting when things go wrong. It's about sitting back, analyzing it. And if a company has a net worth of 10 million and they lose $1 million this year, well, the reality is, with a net worth of 10 million and a loss of $1 million, these guys could lose £1 million a year every year for the next 10 years and still be in business. So I'm not going to, overly react now. Now, if they make a loss of 1 million this year and they make a loss of 4 million next year, now, okay, this is getting serious because they only have a net worth of 6. And if you have another year like that, they're gone. So it's to know what to be looking out for and then make your decisions accordingly. And of course, even if a company is in financial disaster, we'll still do business with them on a prepayment or payment up front or whatever basis. So in terms of closing accounts and not doing business, no, the job of credit, in my view, is that we have to find a way to deliver every order. So yes, if we trust them, and credit is based on trust, that's the whole thing. If we can trust them and give them credit, that's fine. If we can't, then they have to pay up front or whatever. So we look at the warning signs that, hopefully will, post red flags in your brain if and when they happen in the real world. We look at causes of failure. And to be honest with you, there's one cause of failure. They run out of money. That's because, 100% of the time when a company goes, it's because they run out of money. So you can lose money 5 years in a row. You can only run out of money once, and then the business is gone. And, Irish people are funny. If you don't pay them on Friday, they tend not to turn up on Monday. I think Italians are different. I know there's cases of Italian companies where people have worked for months, if not years, during financial problems for no money, just to keep the company going. Anyway, that's that. Now, we spend the first or the third module talking about ratio analysis, and then in the last module, we talk about limitations. So yes, look, ratio analysis are good, and it's a tool, and it'll help you to understand the business and everything else. It's not a one size fits all. So we'll be realistic, and we'll look at and there's things the company can do to make the ratios look well, even when the business is bad behind it. So hopefully you'll be wide to that as well. Failure prediction. So if a business is going down and down and down, we need to be able to look at that and make some predictions based on the trends and financial analysis as well. And the big thing, over trading, and we get this when we come out of a recession. Believe it or not, as we're going into a recession, yes, we have business failures along the way, and we get to the bottom. It's on the upturn that we have even more failures, which is an irony. So we need to look at overtrading. So if a company suddenly grows quickly, sometimes they can't cope with the increased turnover themselves, and they cause problems for themselves. So it's just being able to look at that and their payment and buying patterns and stuff should give you an indication of that. So this is a combination of, you know, words and numbers, and hopefully at the end of it give you an appreciation of the whole risk management function, that you can make the best possible decisions. And you're not going to get it right all the time. I'm telling you now, it's not going to happen. 99.9% of the time is good enough. So they are the 4 modules. Now, I've just given you here the workbook. So with each module in risk, now this doesn't happen to credit management or collections or anything else. In this, you have a workbook. So what we will do is we will give you 2 or 3 pages of notes where we explain a concept to you. And then on the notes, it say you should now be able to answer the first 5 questions in the workbook. And what I would advise you to do is stop there. And so this is the workbook. So calculate the missing figure marked X for each of the following. So we're given 4 pieces of information. We're told what the company's liabilities are, in other words, what they owe, their assets, which is what they own, the income, which is what they sold, and the capital, which is what they're worth. And you're asked to work out what the expenses are. Now, I'm fairly sure not one of you could do that now. That's why you're coming here to learn. So by the time you get to the first part of the first module, you should be able to answer that. Is that okay? And there's a very simple formula that tells you how to do it, and you just slot the numbers in and you'll be able to work out the answers. So you go through your workbook, you fill in your X's that you're happy that all works, and then okay, I know that. Then keep going. If you don't know what that is, then go back to your notes and read it again. And if you're still lost, then you get onto your tutor and say, look, can you explain that formula to me? I'm not getting it. Is that all right? So we're not going to give you a whole course. We're going to break it down by 4 or 5 pages of the notes. There's a workbook for every single section. And again, that's for your own use as well. And if you have any questions, the tutor's quite happy. And they can send you solutions to the workbook with explanations as well, if you wanted. So that's the thing about risk. These are an idea of your short tests. So again, it's in a different format to the workbook. Again, so this is your first short test. So you're given a figure and you're saying, look, this is the company's income, this is their assets, this is their capital, this is their expenses, what are their liabilities? So you work out your formula, work out what that is, and there's extract, from a trial balance. What is the value of gross profit? Then that's a sneaky little one, because there's 2 questions there. What is the value of the gross profit, which is A, and what is the margin percent, which is B? So there's 2 parts to that question. So read the questions, see what they're looking for, and just key the answers into. You'll get your short tests in Excel format. No, it's Word. Sorry, it's Excel format. Yeah, and the workbook is as far as I know, that's in Excel format as well. And when you get the workbook, there's tabs on the bottom for each of the units within the module. So just that you know how to read that. So you answer the 10 questions on your short test and you submit them then to Angelina, and she will correct them and send it back to you. All right, so that's short tests, workbooks, notes. Go through it on a regular basis. I have gone through this. Try to work it out for yourself. But look, if you're lost, there's no need to do it. I have here that we can schedule a revision session. No, I have actually scheduled a revision session. So, and I gave you the dates in the other on the 9th of November that we'll have a revision session. So you'll get your first set of notes, your second set of notes, and your first assignment. And then the Saturday after that, we get together for 2 hours just to go through the first 2 modules and how to go about doing your first assignments in terms of laying out your profit and loss and balance sheet and explaining about adjustments and anything that could cause you a problem to make sure that we get you over the line. So that is that is risk in a nutshell. To me, it's probably um, one of the most challenging topics that we cover. And to me, to be honest with you, it's one of the most important, because if you're doing a qualification in credit management, you have to know more than other people. And this is one area of credit management that I think is vital, and that will define your next step in credit. So you're not just dealing with what's there, you're dealing with opening new accounts, reviewing lines of credit for people to see if we can do more business, and knowing when to go, whoa, hold on a second now, we're heading into too high risk territory here. And then have a backup plan to keep the business going and the money flowing, and without overexposing your companies to risk. So that's it. I hope I haven't terrified you now at this stage. I hope I've given you it's a challenge. It's great. As I say, read it. Never let yourself get bogged down by it. Just you don't have to know every little nook and cranny. What you really have to focus on is a kind of an overview, that you understand the concepts of what's going on. And then when you get into module 3 and 4, that you can analyze it with confidence, that you know what's going on. So I thought I'll stop the recording now.